Okay, we've got Vikash Jain joining us, investment analyst at CLSA. Vikash, good morning. Good to have you with us. Well, we're already hearing, so many views on how outlook is set to change given the current status on ground with the, with the rising cases and of course the shortage of vaccines that we've seen over the last few days. In the near term, Vikash, how high is the risk from an equity market standpoint? What are you observing or factoring in at this juncture?
So I think there are two scenarios. Firstly, thanks for having me. The first scenario is that, and we need to appreciate many differences which are here in this wave versus the last one. Firstly, we are of course much more prepared, but nonetheless, unlike the last one, this could be a much sharper wave because if you remember, same time last year, we were struggling with the number of tests itself. At this point of time, we are having the highest number of daily tests we've ever had in India, almost inching closer to 1.5 million tests a day. If there are so many tests at the start itself, then the number of cases are likely to be higher. The more important thing is, what happens over the next 5-6 weeks. So, there could be one scenario where cases continue to rise, yes, but vaccination also picks up. And maybe since it's a sharp wave, possibly it could be a relatively shorter wave in terms of, the rise and then stabilization or coming off of cases. So if we get to a point where, maybe in the next 3-4 weeks where perhaps we start seeing that, okay, this is the level of cases that we are getting, and we see some kind of stabilization, then maybe market should be okay. And then because with the hope that there's going to be decline post this, because the nature of the disease itself, since it's largely a 2-week infection, and this is what we had, predicted and exactly what happened. If you recall, in September, middle of September is when active cases peaked in India. And within the next 5 months, from about 1 million active cases, we went down to 100,000 active cases, by middle of February. So that's how rapid the decline can be. And in addition to this, if vaccination continues, even if we were to take a slightly lower speed of vaccination, which is where we were at the end of March, India will be able to vaccinate everybody above 45 years in about 7-8 months. So from that perspective, if over the next 2-3 months we continue to see vaccination speed being reasonable, then we will start feeling relatively more comfortable on that bit itself. The only problem is that if this speed of case addition continues to rise, it's quite encouraging that we've seen some declines even yesterday, and some comments coming that maybe there is a chance that Maharashtra and Mumbai could see some kind of a peak pretty soon. If that happens, then even these things will be taken into stride, in my opinion.
Okay, well, that's reassuring to hear, of course, Vikash. We're also heading into earnings. For you, what will be the most critical takeaway this time around? More than the numbers itself, following on from a low base, is it going to be commentary? Is it going to be impact of the rising commodity prices we're seeing on specific pockets? What kind of indicators are you going to be watching out for?
So I think this is interesting. When we started the year, I was particularly nervous about this earnings season, which was coming in. But I think this might sound pretty non-obvious, but what COVID has done is it's in a way pushed reality check by 6 months. COVID, most likely the increase in cases, the second wave, will perhaps make the market a little more tolerant, even if there are some earnings downgrades. So clearly the thing to watch out for here will be clearly the commentary that comes out, even commentary from banks in terms of if they're seeing any credit-related risks and balance sheet risks, since that's a sector which has got hammered badly in the last 3 weeks or so. So essentially, commentary will be the key thing to watch out for. Commentary from consumer companies and others where commodity is an input, how are they able to pass on prices and what impact are they seeing on demand? But I would say the key focus will be, because mind you, the stricter measures in Maharashtra were announced in early April. So only by now would some of the companies have started understanding what is the possible impact of these measures. So that's something which will be watched out for in terms of commentary on demand, as well as impact on margins because of commodity prices. But largely, it's all about commentary in this quarter.
Okay, so Vikash, while we will be watching out for the management commentary, let's talk about styles of investing. And you're of the view that the most successful investing style should be value. Taking that into mind, what exactly is it that you're advising by way of looking at individual sectors as well? And what's the advice to clients in a climate like this?
So we started with this focus portfolio at the start. You know, our focus portfolio from the start of the year had quite a few value names, and we've been a bit fortunate about it. It's done pretty well. If I were to see a simple equal weighted focus portfolio, it's outperformed the Nifty by over 15 percentage points in the first quarter. But the point about value is, I think there is, for the last 2 quarters, value as we define, which is the stocks with the highest discount to their own historical average valuations within Nifty, the top quintile value. And we reset this, every quarter. This quintile has outperformed the growth quintile by almost 40 percentage points in the last 6 months or so. That's pretty phenomenal. I think what this is telling us is that the nature of this bull run has itself changed. It's very different from the rally that we were seeing in the last 5-6 years. The nature of this bull run is now, if you see, a lot of central banks have tried to hand over money to the average person in the economy rather than earlier throwing it on the financial markets. I think those two are very different things, because what used to happen in the last 5-6 years is there was money in the financial market, but people were not so confident about economic growth. And what that meant was people were willing, wherever they could see economic, profit growth, they were willing to overpay for such stocks. I think that is changing. The premise of this bull market is based on actual economy recovering, and that basically, the core economy improving. And what that would do is a lot of that, extended valuation stocks, I am not sure how they would do. And they, people will be more willing to take a look at core economy stocks, which have been laggards for last 10 years or so. And they are in, say, likes of commodity, likes of, infra, and likes of some of those names, which are actually laggards. So that's what I mean by value. And I think the premise of this bull market has changed. And that's something which needs to be appreciated. And for people who are constructing their portfolio, they need to let go of some of the legacy of the last 5-6 years. And, those stocks where they were expensive and they used to continue being expensive. So if I were to look at last 5-6 years, growth was the clear dominant style. So basically, the most expensive stock in Nifty, they used to get more and more expensive. I think that's something which has changed. That's the premise of the bull market. So if you believe in the bull rally, you play it as per the premise. So that's essentially what I would suggest in terms of portfolio construct. The other thing that I would also want to talk about is, not to lose sight of defensives. Now, our focus list of 13 stocks in India, 6 of them are actually defensives. So we have 2 pharma names, we have 2 IT names, we have a telecom name and also a utility name. So 6 out of the 13 are defensives. And we believe, we actually did a recent report where we said that valuations of defensive, particularly pharma, as compared to their own history on a relative basis to Nifty, are actually at one of the, best, the most attractive levels in the last 10 years or so. So not lose sight of defensives and also focus on value. That's essentially how I would pitch it.
Value investing, you believe, is the premise of this bull market. So moving on then, what's the sense that you're getting when it comes to the overall earnings? Where is it that you're likely to see pockets of outperformance? You believe a lot of the high beta spaces, IT as a sector. What is it that you're looking at when it comes to the hits during the earnings season?
So I think more than the hits, where could we, essentially, I think the hits or the misses would be defined by the commentary. And in a way, what kind of expectations are we going into the earnings season? So I would say that expectations are pretty low for banks. So from that perspective, given all the fear, I would suspect that commentary coming out after banking results may be able to soothe fears for many of the investors. So given the kind of correction that we've seen in banking stocks, I think commentary over there could be where we could see some kind of worries getting allayed, and that should be positive for some of those names.
Sure. Vikash, though, is it a given that Cyclicals is a place that you got to be in? Q4, you'll see strong commentary, and even going forward, at least for metals within Cyclicals, the going is strong. Not just, Biden's $2.3 trillion infrastructure package, which is sentimentally auguring well for global commodities, but back home as well, with the 13 consecutive HRC price hikes that one has seen. Is metals a good place to be in even going forward?
So you have the top two metal names in our focus portfolio. And, essentially, like I said, coming back to the point on the premise of this bull market, it's essentially based on economic growth coming back. And that would be typically mean commodity prices going up. That will mean yields going up. So those things are good for, commodity producers as well as maybe banks. Yields going up is something which is good for banks. So that's really how we are positioned. So there are, either you don't believe in this bull market at all. So if you don't believe in this bull market and you're nervous about it, then maybe, whatever I'm saying is not relevant. But someone who believes that the bull rally continues, after this perhaps a small break during this fear around COVID, where, largely it's been an India-related underperformance, then I think one needs to be positioned for the next leg of the up move, and which is what this will kind of provide as commodity producers. And so the non-defensives that I'm talking about would largely be commodity producers, would largely be, something like some infra names would be banks. So essentially that's what I'm looking at, other than a few, bottom-up picks as well.
Vikash, for the overall market sentiment, though, the fact that rupee is already at an 8-month low, I mean, as of yesterday, we were already at August 2020 levels. You think that is a niggling worry in the backdrop of the FII's already net sellers for all through this month?
So I think, that is definitely a niggling worry. And I think it is very India specific. It simply comes from this belief on, whether essentially that what the nervousness around the COVID cases in India. So clearly that's something that we touched upon at the start of the chat. So I think that worry will get addressed as we perhaps reach a more comfortable situation on the COVID scenario. It's not, we've done some of this data analysis. Over the last 15 years or so, if you were to look at periods when rupee has had a sharp depreciation, very sharp, say 4 or 5% depreciation in a matter of less than a quarter or so, those periods have, of course, obviously been good for pharma and IT. In addition, they've actually been pretty bad for banks. And I think exactly the same thing has played out over the last 2 to 3 weeks.
Sure. Okay, I'm just going to pause here for a second and just quickly get you a status check on what the market is up to. It was a quiet start. It continues to remain so. Just 0.4% higher is where we're currently at, circling around the 14,400 mark. The breadth, yes, is in the positive. But, today's move is not looking all that convincing, really. TCS, look at that. 3.5% slide is what the stock has seen after what turned out to be an inline set of numbers. The brokerages were mighty excited and very, very bullish on TCS's numbers, but that isn't quite reflecting in the market momentum or the market reaction right now. Growth in 2021 was about 3%. Profits were flat, but yes, in line with expectations. The double-digit growth that it's posted in the current year is a large part due to the slower growth that it last year. So, it's typically a case of the base effect as well coming into play. So will that spell really that margins are going to be under pressure while the outlook does definitely protect downside, but can it assure any upside in the stock? Today, it doesn't seem to be the case because today TCS is a big drag, is down about 3.5%. And along with that, you're also seeing some profit taking for a Lalpath Labs, a Mindtree, Coforge, etc. Vikash, what TCS is doing in today's trade, that aside, but you think the tilt of the market will continue to be pharmaceuticals? If the correction were to actually be a little long-lasting, and if yesterday was not it, you think money is going to again move out of economy-linked sectors and move back to IT pharma?
I think if that is the case, then essentially the other thing that I'd like to highlight that almost 5 out of the 13 stocks that we have in our focus portfolio are actually outward looking. They are not just domestic economy stocks. So whether you look at something like a metals, or whether you look at a pharma, or whether you were to look at even IT names, in fact 7 out of the 13 names, those stocks are less dependent on what's happening in India. So from that perspective, and like I said, that the current move is more to do with domestic, situation being uncomfortable. So clearly money will move into those names, which are more export-oriented or commodity-linked, where prices are globally determined. So yes, that's something which could happen if the situation remains uncomfortable.
In your model portfolio, you're also talking about, or rather your focus list, you're also talking about some bottom-up stories that you do like. Where in the market are you currently finding these bottom-up stories? And again, is it sector agnostic? Is it market cap agnostic? And are you just looking at individual stocks right now?
So firstly, since we have a focus list, we try and keep it at the level of, large liquid names. So it's largely large cap that the focus list will contain always. Within that focus list, we actually, in general, I do not like autos as a space, but we have 2 auto names. Both of them are more bottom up. We have a telecom story, which is more bottom up. So there are a few bottom up picks, which is, when I look at bottom up picks, it's more about how we feel about that name rather than just being, looking at it top down. So there are many of these names, like a commodity name or an IT name or a pharma name, where there's some element of it being top down. But there are some of these. So it's interesting that I do not like auto as a space in general in comparison to other sectors. But there are 2 of these picks which are auto picks, which are there that we have just because we like the bottom up story a lot.
Sure. Vikash, give me a sense of what you're also tracking on the global front with the yield curve, and then of course we've had more reassuring commentary coming in from Powell and recovery that seems to be on track. In terms of how some of this will impact fund flows into EMs, just share with us where you're at on that.
So tactically speaking, what is happening is if you bring all of that picture together along and overlay the COVID situation as well, in the next 4 to 5 months, the UK and the US can get all of their adult population vaccinated. And here we are, some of the EMs like India are facing a situation of kind of a second wave, or, because of the sheer size of the population, the pace of vaccination will not be touching that higher proportion of the vaccination so. So I think tactically speaking, our global portfolio strategist has already recommended an out of consensus view that we believe that US would do better than EMs. So that's something which which we kind of came out with a few weeks back. And I believe even if I were to look at the situation in India, perhaps the first part of this quarter, there will be this nervousness around COVID cases. And maybe how this will change or how this will emerge is, say, in about 3-4 months when things open up in the US and UK, where a lot of our investors sit, and they start seeing the benefits of vaccination in terms of bringing some kind of normalization in life. That's where I suspect that they would start thinking about reopening and economic normalization trades in EMs as well. In those EMs which are able to make some progress in vaccination. And I think, like I said, that if India takes about 6-7 months to vaccinate all of its 45-year plus population, 3-4 months out, we'd be feeling comfortable in terms of where we have reached on vaccination. So on an overall basis, I think although there will be some nervousness in the next few weeks, 3-4 months out, India could come out as a place where people will want to again play that trade where things will normalize soon and kind of take some kind of exposure back. But yes, tactically speaking, this is a period where some of these economies which have also taken up some kind of have progressed further on vaccination could do much better.
Okay, great. And, in terms of within EMs as well, I mean, again, the ground is looking shaky. We've already got credit agencies talking about how they're watching to see if they need to revise their outlook. But other than that, do you feel that India was or is in a sweet spot, even if we perhaps look beyond the next couple of quarters?
So I think when we came out with our year ahead piece, the one key thing to highlight, and that's not changed when we did this very recent report in a way, taking stock of what happened in the first quarter. If I were to look at markets based on earnings growth, only Brazil, which is largely to do with the spike that we've seen in commodity, and Korea have better earnings growth stories in all the top 20 biggest global markets. Only those two markets have stronger earnings growth than India. So India remains one of the best earnings growth stories. Perhaps, also if I were to slightly relative valuation premium of India to MSCI EM or to MSCI Asia X has also kind of cooled off a little bit. It had reached a +1 standard deviation level at the start of the year. Because of only mid-rung performance during the first quarter, that has come off a little bit. So as long as that belief in earnings growth stays, this is a 3-year earnings growth story that we are talking about. I think there should be some favor for India when it comes to portfolio allocation. That we've also seen in flows. India remains by far the biggest beneficiaries of flows amongst the EM markets. So that's something which I suspect could continue other than this small, temporary period of worry during the second wave.
All right, we'll let you go on that note, Vikash. It's been a pleasure just understanding the entire texture of the market, your style of investing, as well as where it is that you're seeing opportunity. Thanks so much for joining in.